Hi, my name is Jordan Wilson. Today we're going to take a look at investment risks, specifically the non-systematic risk. When we looked at investment risk before, we considered it as the standard deviation of the expected return on an investment, a numeric value. And that's based on the historic returns over time, future expectations, modeling. All sorts of calculations go into creating a standard deviation. Part of that is the systematic and the non-systematic risks. That's more of the qualitative side. And that's what we're going to look at in two parts. Today we'll start with non-systematic risk. So our objectives over both parts are to compare and contrast non-systematic with systematic. They're basically complements of each other. We're going to discuss a bit why understanding these two risks are important in the investment process. We're going to look at some examples of the main risks in each class and some questions to consider when we're analyzing potential investments, whether they be companies, stocks, bonds. And finally, we'll look at how to mitigate the systematic and non-systematic risk. And we'll see that, like the pure risks that we covered a couple of sessions ago, there's some similarity, but there's also some practical differences. And there's also some differences between the non and the systematic risks. So let's get started. Non-systematic risks. Those are unique. They are specific to the business, to the industry, to the asset, or the investment. They're also known by a variety of other terms that you'll see. My favorites would be specific, because they are specific to an investment. Non-market, and we'll see why that makes sense when we look at systematic risks. And perhaps my favorite would be diversifiable, because that's a hint on how to mitigate. So why are non-systematic risks important? Well, they'll help you understand the risks that are involved in a particular investment, and that'll help you mitigate them. It'll also help you in your qualitative analysis when you're comparing potential investments. So it helps if you're looking at a investment by investment basis to build your portfolio, that you understand how to analyze different companies and what the risk factors are. So some of the common ones that we're going to look at today are management risk, operational risk, competitors, customers and suppliers, credit and legal. So management is probably the most important non-systematic risk. Management would include the board of directors, officers of the corporation, and also key employees. And key employees would be those employees who make the company what it is, what makes it attractive to the acquirer. Maybe that's a key scientist in the research and development department. Maybe it's a key sales team. So whoever is important to creating the actual success of the company that you're buying is a key employee. And that's why you often see the term would be golden handcuffs during a merger or acquisition. You financially incent the key employees to stay with the company for at least a minimum period of time in order to transfer that value or continue with that value that they provided. If you buy a company and all the key employees leave, then that could cost you the reasons why you purchased it in the first place. Management is very important in fund companies. So if you invest in a mutual fund, for example, the people that run that particular fund would be the key managers, the key employees in that situation. Right now, some key employees, key managers, Steve Jobs, who was previously at Apple Computer, Warren Buffett, Berkshire Hathaway, Elon Musk, Tesla. So at times, especially with Jobs and Musk, they've been in and out of vogue, but at the moment they're considered strong managers and successful visionaries. On the other extreme, you have people like Ken Lay from Enron. You have the men that ran Bre-X Gold in Western Canada. Or from a financial advisor perspective, Bernie Madoff. So if you're investing and you're giving your money to Warren Buffett or Bernie Madoff, that may indicate how well you're going to do in the long run, or not. So management, key employees, very important. Some of the considerations that I would have are, what's the track record of the management team? How is new management perceived? Is there continuity? Are there succession plans? What's the corporate ethos? And if we look at an example, let's consider a mutual fund company, ABC Company. Over the last 10 years, it's outperformed its competitors, and you're thinking of investing in its equity fund. A couple of days before you go to invest your money, you notice in the newspapers that the two fund managers have left ABC to start their own fund company. So, will the new fund managers continue that track record of success? Maybe, maybe not. You have to look a little deeper. Who are the new managers? Is it the deputies of the two that left? So you have a continuity. Did the company have a succession plan in place to ensure that there was that continuity and continuation of the investment philosophy and investment style? Or is it somebody off the street who has no track record with ABC? And then you have to look at their past performance. In a small business, succession planning is huge as well. If I'm an electrician, a plumber, it's the same as with the mutual fund company. If the head person leaves, will that be the same company tomorrow? If I'm using Bob the plumber and he retires, will his successor provide me with the exact same service? So again, small companies, large companies, fund companies, these are the issues. It also helps to look at the corporate culture, the corporate ethos. Back in the earlier days, basically Warren Buffett and I think Charlie Munger basically ran Berkshire Hathaway at the top. They were the head guys, made all the decisions. But as Warren Buffett aged, he started surrounding himself with a much bigger and much stronger set of deputies. So yes, I mean, I will grant that Warren has a lot of inside access. For example, his time as a board of director on Coca-Cola. But in large part, when he finally steps down, or if he suddenly passes away, there will be that continuity in the investing philosophy and the investment strategies from his deputies. So you probably should not see too much change in how Berkshire Hathaway runs things. Now that could differ in other industries. Again, Elon Musk has got to that critical mass, but not too long ago, if something happened to him as a big visionary with Tesla and the space ventures, that could have put everything off the rails. So you need to look at how does the corporate culture operate as far as continuity, succession, these sort of things. In my businesses, I've always had a hit by the bus philosophy. If one of my staff is hit by a bus and has to miss a significant period of work, is there someone else that can step in and do the exact same role at the exact same level? And if you look around your business and the answer is no, that probably should change. So let's turn to operational. Now, operational and management are quite closely tied. And that's just the risk of how you run your business. Now, obviously, that'll vary wildly between different companies and different industries. A mining company is going to have much different risk issues on an operational basis than a high-tech business. Mining companies may have risks of environment, cave-ins, all sorts of things, theft of product. They don't actually have a lot of retail customers. So if you're running a computer company, you're producing a product that you're selling to the masses. Much different risks, much different environment. But the questions on some level are still similar. You don't have to be exhaustive, but for the main risks, you should list what they are for the company or the asset under consideration. And then for these major risks, what steps have the company taken to minimize or mitigate? So if we're worried about pipeline spills in an oil company, what is their track record of environmental safety? Have they had past incidents? How have they dealt with it? Again, corporate ethos. Are they trying to cut corners, or are they going over the top to ensure that safety is job one? What are the trends? What is the focus in that business area? 50 years ago, you turn on the old Clint Eastwood movies on TV that still run. Everybody's smoking. Same in all the movies and TV shows. Everyone's smoking. But then at some point, healthcare concerns and the focus shifted in the world just to a more health conscious, anti-tobacco world. So Philip Morris, BAT, these companies were just money makers for so long. And then suddenly the world changed. That's a risk. And that's something that you have to focus on. We saw that again on a smaller basis if you look at, say, the Exxon Valdez in Alaska, or British Petroleum, their oil spill in the Gulf of Mexico. Suddenly these events happen, and there's an increased focus, maybe short-term in some cases, on environmental safety. And so, again, when you see these things happen, you've got to say, okay, I'm investing in an oil company. What's the risk if this happens? What's the risk if that happens? So that's sort of things that I would be concerned about with the management and the operations. Let's take a look at a couple of others. Another risk that's worth investigating, although it's a little bit difficult at times, is competitor risk. So that's the risk that your competition is going to come along and eat your lunch. Sony Walkman. They were kind of cutting edge back 70s or 80s, whenever it was. You had the Walkmans and the Discmans and all this sort of stuff. And then along came the iPods. You don't see too many Sony Walkmans out there anymore. Same with, say, Nokia mobile phones. When I lived in Europe, Nokia was by far the dominant cellular phone company. But there was no iPhone back then. Then iPhone came along and has taken over, along with Samsung Galaxy, a large part of the market. You see it with a mom and pop shop. How long can they last versus Amazon or Walmart, for example? Both behemoths that control a lot of supply chain and are forcing the smaller people out of business. 20 years ago, you didn't have Amazon to worry about on any scale. So the questions are, with competition, what will protect your company, your stock investment against the invading hordes. Now, most of this is called moat investing, just like the castles with the moats surrounding them in the Middle Ages. So what barriers to entry exist that don't allow a company to come in to your industry? Now, in the automobile industry, for example, it can take a lot of capital. You can't just probably start up a car company in competition with Toyota, Honda, Ford as a small business person. There might be a niche, yes, but on a mass market basis, not very easy. So your ease of access, your costs, research and development, is that something that gives you a competitive advantage over others? Do you have patents? Do you have proprietary information? Do you even have goodwill? Say Coca-Cola. It's probably hard for a small soda company to get in and compare against Coca-Cola because everyone knows Coca-Cola. And again, think of that as moat investing. That's a common term these days. Key customer, key supplier. Two sides to the same coin. What is your reliance on the key partners that you have? And you can think of this as sort of an eggs in a basket approach. I would be looking at if 80% of your business comes from one contract or one customer, then that's a lot of eggs in one basket. You often see that with government contracts. So a government will sign a contract with a company for a 5-year deal. The company's happy, but what happens at the end of 5 years? What's the probability that the company will be able to renew? On the supplier side, Walmart, well known for squeezing its suppliers. So again, if I have a dominant share as a customer of yours, and I know that, I can squeeze you on pricing because you'd rather have 50 or 60% of what you get now, so I continue on and renew my relationship with you, than 0% of the original price as I go elsewhere. And it's the same on the supply side with, say, the Walmart, where they tell their suppliers, sharpen your pencils because we won't come to you. Now, I think you got to look at the risks. What's going to happen if that client or the supplier is lost? Or what happens if they just use that leverage to reduce your operating profit margins? Now, one example that I just want to give on this is it doesn't even really have to impact your business directly. So let's say you operate a fishing lodge in northern Canada. There's 2 airlines that service your company or your lodge. Clear Sky is your preferred carrier, has better prices, better flight times. Junk Jet has poor reputation and a poor service level. Everything's going well for your lodge. ClearJet is an excellent business partner. Your customers are always happy with the service. But nothing to do with you. Clear Sky changes its business model and no longer serves your lodge airport. So you're forced to use Junk Jet. Being the only game in town, Junk Jet raises their prices 100% for flights to your lodge. To be competitive with other fishing lodge options in the north, you cannot pass on all the increase to your clients. So your profits fall. Then, because junk jet has relatively poor quality, the overall customer satisfaction in your lodge itself falls. And that causes business to suffer on top of anything else. So unless you find a new air carrier, there's a good chance that your business will continue hurting, and it may ultimately cost you the entire business itself. So even in a situation like that, a lot of things are outside your control as a company, but you have to factor that in. And as an investor in a fishing lodge in northern Canada, that would be one significant issue to look into. The final two non-systematic risks I'd like to cover are credit and legal. Credit risk is your default risk. That's the ability to make good on your corporate financial obligations, business contracts, accounts payable, paying back the bank, paying investors on interest income for bonds and repayment of principal, even some dividends on common shares and definitely on preferred shares. So your ability to repay is a credit risk. Things I'd look at include, what are the key ratios? Say the debt to equity ratio, the quick ratio. How are the cash flows looking? That's probably more important than earnings per share, because if you need to be repaid in cash, earnings are often non-cash. More importantly than the ratios themselves is their quality. I have a nice debt to equity ratio, so I can repay my debts, at least on paper. But what happens if a large component of my assets is a old warehouse that's on the books for $10 million? But really its fair market value or its liquidation value for a practical purpose is more like $1 million. If I have to sell that to repay the debt, maybe the ratio isn't quite in line with reality. So that's an issue. Timing is another. So that same factory on the books for 10 million, and let's say it's worth 8 to 9 million. But the bulk of my debt, or the bulk of the company's debt that I'm considering to invest in, is all short term, 60 days. It's accounts payable, short term debt to a bank. So you need to match, when you're analyzing the ratios, the time periods. If I have long-term assets that maybe I can't liquidate quickly, or if I'm running the warehouse still or the factory, I need to continue with that. Maybe I can't sell it. I can't sell the machinery within it. So how am I going to repay those short-term loans? What's my ability there? And that's things more like, say, a quick ratio. Another issue when looking, especially on the debt side, is what's my security if I lend this company money? Are they issuing me a mortgage so that I've got a right to that asset if the company fails to repay me? Or am I general creditor, who if the company fails, I have to get in the back of the line and wait my turn, and if there's money available to repay me, great. If not, that's the way it works out. And even if you do have a lien or a mortgage on a property, what's the quality of that property? On a liquidation basis, if you're given it in a bankruptcy, how much of the actual debt will that cover? So those are issues on the credit side. Legal risk is, to me, maybe the most important other than management. Typically, legal risk is going to be tailored to an industry or product. Say product liability can be an issue, corporate negligence. And we talked a little bit earlier, we compared a mining company with a computer company or a high-tech company. Let's say a computer company creates a computer, it's got electrical issues, it ends up shocking and killing many people. So you have a product liability issue for one. And that may be replacements, so there's a cost involved in the business. Maybe repairs, there's a cost involved in the business. It may be people demanding their money back, there's a cost. And more importantly, I think from that side, if I'm buying a company's computer and I've just read that there's a bunch of electrical issues that are going to potentially kill me, am I going to be a customer of that company? So there's also lost sales, and that's a cost of business. Corporate negligence. If I'm selling a computer that I perhaps know runs the risk of killing my customers, maybe there's criminal liability. There's definitely going to be lawsuits, because what you find, just as a general comment, is there's always the deep pockets theory. So if this company is Dell Computer or Apple Computer, they have deep pockets. So people are looking for ways to extract some of that money for their own genes. And I think we see that at times now with Tesla. Very deep pockets there at the moment, given the share price and the wealth of Elon Musk. So when a Tesla goes on fire, which seems to be an occasional issue with Tesla these days, is that something that we can sue Tesla for? So we got to look at, what are the possible risks? If I'm a mining company, what are my legal risks there? If I'm a high-tech company, what are my legal potential risks there? And we saw, when I talked about Philip Morris or the BP spill in the Gulf of Mexico, government trends can kick in. So something that happens can create visibility, can create new regulations, can create lawsuits. Tobacco industry was a popular product back in the 50s and 60s and probably the 70s. Much less so now. You also want to look, I think, when you're asking yourself questions, what's the past experience of the company or the management team? So if I've got a company that runs an oil pipeline, and over the last 20 years, they've been involved in multiple oil spills, environmental issues, all these things. Let's call them a poor corporate citizen. Then what's the risk that going forward, there'll be more problems with that company, as opposed to another company that goes overboard to ensure that environmental issues are considered and dealt with before they occur? There's probably a better probability that there will not be an accident with the second company. And if there is, their past history of strong performance in that area may save them some negligence or lawsuit issues. So those are kind of some of the issues I'd look at with legal. And if I'm doing a merger and acquisition, which I've done many of in my career, one of the first things that I grab when we get the opportunity to go into a company and do some due diligence is the legal file. What skeletons are out there and what risks might come back to bite me if we end up buying this company. That's it for today on non-systematic risks. We'll move into the systematic risk next time. Thank you for your time today, and I wish you all the best in your investing endeavors.